market movers. This is The Pulse with Francine Lacqua.
Well, good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London. Now, more uncertainty this morning with the White House planning for tariffs on generic drug imports. There's also the threat of escalation in the Middle East. In just a moment, we'll be joined by Johanna Kyrklund, Chief Investment Officer at Schroders. But first, earnings season heats up this week with Alphabet kicking off mega cap results later today. Investors, of course, cautious as recent volatility in the semiconductor market has underscored doubts around AI spending. So let's get more with our Bloomberg Intelligence analyst, Matt Bloxham. Matt, thank you for joining us. I mean, there's just a lot going on. So what are you specifically looking out for in the AI sector?
Yeah, so I think the big focus for me, at least, is going to be on the Google results because it gives you the broad spectrum of everything that's going on from the ads business, which is their core revenue and cash flow driver, which is to some degree under pressure from the AI shift, all the way through to their cloud business and what they're spending on infrastructure. So you kind of get a bit of perspective on every part of the value chain. I think actually what we're going to see is that the ads business is holding up incredibly well, probably growing more than 20% year on year, and that they're transitioning into a more AI-led internet environment than perhaps people worried they would. They've obviously already increased their CapEx guidance significantly this year and have indicated that next year CapEx will be even higher again. I think people were looking for a little bit of an update on that, and if there's any clues about what significant increase next year means in hard dollar terms. Yeah. But I think beyond that, it's also about whether they're actually starting to make any kind of return on investment in those big CapEx outlays. And so I think that's going to be a bit more of a kind of opaque set of Q&A, but I think that's where people are going to be focused.
Matt, then we have this pretty extraordinary story out today. OpenAI says its advanced artificial intelligence models basically inadvertently, hacked Hugging Face. I mean, this raises questions about, the ability to carry out cyber attacks.
Yeah, it does. Obviously, we already had a kind of a precursor to this with the Anthropic Mythos that demonstrated incredible cyber capabilities. Seeing similar things with OpenAI's tools. I think what's interesting is that this was an agentic-led attack, and to some degree was kind of intentional. They were trying to test the capabilities of the model, but the Hugging Face responded with its own agentic AI capabilities. So you kind of got this new cyber warfare if you're going on between agentic AI. Just kind of raises the bar again in terms of what you need to be capable of doing in cyber warfare. And, it's good that OpenAI have been transparent about this. They're showing what they did, why they did it, how it worked, and they're working with the likes of Hugging Face so that they can understand the capabilities of these models, that they can boost their cyber defences so that, hopefully we kind of end up in a similar situation where, every day there's a warfare going on in the background on the cyber front between bad actors and good actors. It's no different in the AI world. It's just a lot more sophisticated.
Sophisticated, but it also feels like a big deal, right? Because it's the first incident. So if you're a government, are you worried about regulation? And eventually, will these models and systems be able to patch it?
I think you're worried about regulation, but you're probably more worried about systemic risk, really, and in many different ways. Right. And I think probably that the risk of a major event happening now is much bigger than it was. There's always that risk, but I think that there was a good balance in cyber warfare. Now I think there are kind of unknowns, if you like, of what could happen. It could be really quite significant, both in terms of national security, financial systems, energy supply. So I think this has gone right to the top of the priority list for governments in major jurisdictions as they try to figure out the best way to contain and control this.
Matt, thank you so much, as ever, for joining us. Bloomberg Intelligence analyst Matt Bloxham. And let's get more on the AI trade with Johanna Kyrklund, Chief Investment Officer at Schroders. Johanna, thank you for being here. Look, I mean, it's just a big day because we have a lot of earnings from the tech sector. Where do you see value right now? Are you going to find out this week whether actually we're going to see return on investments, or could it take longer?
I think Matt is absolutely right. The key question now is really whether we're getting that return on investment on all the expenditure. That would be the key question in the tech sector. In terms of value, I mean, I wouldn't say you can see value in the tech sector at this point. There's evidence of quite a lot of froth in the AI supply chain, which is really what's driven, I think, this sell-off in semiconductors in recent weeks. It's just too much froth in the system. We actually see better value. Obviously, value stocks, if one's looking for diversification from AI, value is a good strategy. But interestingly, quality is also looking cheap. It's quite unusual to get what I call the eclipse between quality and value. Why are those quality stocks cheap? Is in many cases they've been caught up with this AI disruption story. So that, again, it's the other side of the AI trade. But that is unusual and an opportunity, I think.
So what do you do with AI stocks or AI-adjacent stocks right now?
Well, we are looking at it. I mean, we've been advocating for a long time that you need to look at it stock by stock. We still believe in the AI story. The question is the valuation. And what we're concerned about is particularly the frothiness in the supply chain. Yeah.
So when you look at, I mean, do you have to stress test any other industries that you're looking at? Or again, is it too soon? I don't know what kind of timeline we should be looking at.
I think the challenge now with the AI story, so if you think about it, a couple of years ago, it was really a US mega cap tech story.
Yeah.
And really what we've seen in the last year, it's extending into Korea, Taiwan, so you don't get the same geographical diversification you used to get. And of course, it's now increasing as a percentage of the investment grade universe as well. It's prevalent also in the private asset world. So actually, when you try and do sort of, you can't diversify away from it in asset class terms. I think you really need to think through the portfolio construction on the equity side now. And it's the first time we've really been talking about that. We've been quite happy to ride a lot of these trends in recent years, but I think that now we need to start managing that risk. And so equity portfolio construction is top of mind at the moment.
So how do you do it differently?
I think we need to think about leaning back from some of the frothier areas, looking for opportunities in the quality side. As I said, exploiting this overlap between quality and value, which, as I said, is quite unusual.
I mean, there's also, of course, overlaying all of this, there's a risk of geopolitics, and that leads to higher inflation. I mean, inflation numbers haven't been too badly either here in the UK, Europe, but also the US. Is there a danger that we're lulled in a false sense of security given all of the geopolitics in the Middle East? So geopolitical situation continues, and I think we've been advocating for a long time having allocation to commodity-related areas. We like energy for that reason, and I think you just have the hedge on, and then you try and ignore the daily volatility. We can't trade the headlines, but I think you need to have that diversifier in your portfolio. Bonds are interesting. We've generally been negative bonds really since 2023. But now we are at a point where we think that rate expectations are actually more realistic. If you think about it, we started the year with rate cuts priced in, and now markets are pricing in rate hikes. So actually, for the first time in 3 years, we're starting to see value in US government bonds. They're not diversifying. We're still in a stagflationary environment. But certainly from a trading perspective, there's potential opportunities. Of course, we're pushing up against the top end of the range at the moment. But I actually think the two things I've been worried about for the last 2 years have been the concentration in the AI theme and US 10-year, because that's the ultimate constraint on populist policy. Yeah. Right now, I'm more focused on the AI story as a risk, as opposed to the US 10-year, which I think now is better priced than it was. Johanna, what's your take on the Fed? Actually, it feels like, you know, new chair Kevin Warsh is on this like push of credibility. Does that make him less likely to hike rates this year?
We think that they are likely to hike rates because even leaving aside what's happening in the Middle East, we continue to be of the opinion that the US economy is quite strong. The US labour market is quite resilient. So that would be our bias. I think there's a lot of talk about the, abandoning forward guidance. I actually think to some extent that makes sense. I think forward guidance gave a false sense of security, this idea that all the Fed that people knew exactly what they would be doing on rates. That is not the reality.
Which is impossible.
So I actually think that is probably a good shift. Okay. I mean, we managed without forward guidance for many years, It's a fairly recent phenomenon. So I think we can live with that. And I think that so far Warsh has demonstrated a need to maintain credibility. And, rate hikes are possible this year in the States.
Yeah, and the ECB is really, really pushing back against this forward guidance. They really talk about scenario planning. I mean, the UK, it's been a big week because of the new Prime Minister. What are you expecting, and what does that mean for investing? If you look at the difference between treasuries and gilts, I don't know whether maybe it's time to think about gilts.
Well, I think there is we do need a bit of a political risk premium in gilts. Clearly, we're leaning a bit more left now. We'll have to see what they do in the next, as we head into the autumn. So that is a concern. A political risk premium, I think, is warranted. Yeah. But again, I think often when we look at the gilt market, we look at it in isolation, when really it trades in lockstep with global bond markets. Yeah. And given that we are slightly more relaxed about the US 10-year tactically, I think big picture, sell-off in the 10-year is what will ultimately end this bull market. But for now, with inflation behaving itself, more realistic rate expectations, we think we could muddle through the summer. And that means if the US 10-year is fairly stable, I think the gilt market can muddle through the summer as well.
So are you waiting for the budget, really?
Yes, I wouldn't be bottom fishing in UK gilts. No, I wouldn't. Because
anything
I think
in equities?
Equities, I mean, we're still tilting positive because the earnings momentum is there. So, we maintain that position.
I mean, there's been earning momentum across the board.
Yeah.
It feels almost in every region.
Yes.
Is that surprising, given everything that's been thrown at the economy in terms of trade, geopolitics, higher oil?
We've been positive on the market for a couple of years now, really on this idea that the cyclical outlook was positive. We've seen very low risk of recession. And, of course, all this government spending boosts nominal growth, and that hides a multitude of sins when it comes to corporate earnings. So, generally, we've been positive on corporate earnings, and we think for now the evidence is it can continue, with some concern about froth in the AI side of things.
We're spending a lot of time talking about Japan. The BOJ, we understand now, is set to open the door to faster rate hikes pace. You know, the yen is something we watch closely. Again, do you look at that part of the world, especially Japan?
So we're long Japanese yen on this view that the BOJ will have to tighten policy. We're doing it against the Canadian dollar. Okay. So we're slightly, we're not going in the eye of the storm on dollar yen because, of course, there's the potential for rate hikes in the US as well. But we do like the Japanese yen against the Canadian dollar. We see opportunity there. Where
do you see the biggest opportunities overall, again, giving these risks and these shifting sands?
I think the core position still needs to be exposed to equities. We're in an environment, a set of low recession risk with some inflationary risk. In that environment, equities are probably the workhorse in terms of generating return. You need to have some exposure to commodity-related sectors because of what's going on in the Middle East. And I think you need to think about tilting away from the more overvalued parts of the equity market, so thinking through that portfolio construction. But really, that is still the epicenter of our portfolio, is the equity risk.
Emerging markets have been doing quite well. Will they continue on this trajectory?
They're correlated with the AI trade. So know what you own and understand that it's not a diversifying position at this point in time if you're doing it passively. Generally, we like emerging market economies because, unlike the West, where we're throwing out the rule book on fiscal profligacy, actually, a lot of the policies pursued by emerging market economies have been a lot more credible. So structurally, we like them. We like emerging market debt. But I think if you're accessing emerging equity, if you're doing it passively, understand you are still correlated with the AI trade.
I mean, a lot of the stimulus over the last 8 months came from the U.S., right? And also a lot of the uncertainty. Does anything change after the midterms? Are you starting to think about, what that means for the U.S. politically, but therefore economically and the rest of the world?
Yes, I mean, the big driver for us has been this idea that the US had low risk of recession with this level of fiscal spending. And we have to see how that develops politically as we head into next year. So we're definitely late cycle here. And, I do get more worried as we head into 2027. Because valuations are expensive, because cyclically I think we might be petering out momentum-wise, because we need to watch inflation expectations. They've been very stable so far. Could they start to get unhinged? There are risks out there.
But a big correction is your main worry, or just pockets of corrections that then stabilize?
I think in the end, what I'm most concerned about is the point where I think we could be moving into an environment where rates are higher and we start to get a downturn in growth, which we haven't had for quite a while. So I would see that as a major shift in trend, but not something I'm worried about right now. I see that as a 2027 issue.
Johanna, thank you so much for joining us today. That was Johanna Kyrklund, Chief Investment Officer at Schroders. Now, coming up, President Trump threatens 100% tariffs on generic pharma imports. We'll have the details next. And this is Bloomberg.
July 30th. The Bank of England makes its next interest rate decision, and investors will look to BOE Governor Andrew Bailey for signals on the rate path ahead.
Inflation is higher than we expected. Of course, now what we've got to do is get it back to 2%.
Join the opening trade team for live market reaction and analysis and on-the-ground coverage at the Bank of England. It all starts July 30th, 12:30 p.m., only on Bloomberg. Live from UN headquarters, a special town hall with candidates seeking to become the next UN Secretary General, discussing their priorities as the United Nations confronts mounting global challenges. Organized by the Office of the President of the General Assembly with the support of Bloomberg.
The conversations that matter, the insights that you need. This is The Pulse, and I'm Francine Lacqua here in London. Now, President Trump says generic drug makers have 2 years to move production to the U.S. or face 100% tariffs from August 2028. Now, that levy could double a year later to 200% in August 2029. Let's bring in Deirdre Hipwell, Bloomberg's healthcare and consumer team leader for EMEA. Deirdre, as always, thank you for joining us. So what kind of impact could it actually have on consumers, but also on prices?
Potentially could have a really huge impact. About 90% of the drug prescriptions in America are generic. So any move to change how their supply chain works will potentially be, really quite significant. And, Americans are buying generics on everything, antibiotics, painkillers, even cancer drugs. I think the key will be to see how these tariffs actually take effect, because as we know, Trump tends to make big announcements and then try to strike deals.
So I wasn't expecting this, but I'm not in it as much as you. I mean, was the industry kind of prepared? Have supply chains we know have kind of changed because of COVID. So is this just another layer, or does it really come out of the blue?
I mean, Trump has been targeting the drug industry since he came back into power. I mean, he has long expressed annoyance, concern, irritation in the way that only Trump can do about how Americans are paying a lot more for drugs than pretty much anyone else in the world, and that American innovation is subsidizing drug prices in the rest of the world. So, as we know, he's already gone hard after the big branded manufacturers, and he struck deals with many of them to lower prices. He launched Trump RX, which is a big direct-to-consumer drug platform. So he has been after the drug industry for a long time, but obviously going after generics manufacturers is a very different kind of kettle of fish, because they operate on much lower margins, they have less fat cuts, so it could be interesting to see how this plays out, really.
And then, in other news, Novo Nordisk is suing Eli Lilly. So this, again, feels like a big deal, but what are they accusing the rival of?
Yeah, never a dull moment at the moment in the drug industry. So they are arguing that adverts that Lilly has been putting out since April are misleading, because what they're saying is that Lilly is using a bona fide direct head-to-head scientific study, but what they are saying is that they now have a higher dose version of Wegovy, and so if you were to include that, it's not correct to say that Zepbound is just completely beating Wegovy out of the park. So they'd already sent a cease and desist letter in April, which it seems like Lilly pretty much ignored, and now they are, they're taking legal actions. So it's just more of the same as they kind of battle to try and, gain dominance, and for Novo to assert dominance that it once had but lost to Lilly, whose Zepbound sales are taking the lead from Wegovy.
I know it's a story we'll follow very closely. So, Deirdre, thank you so much for joining us. Deirdre Hipwell, Bloomberg's healthcare and consumer team leader for EMEA. Now, Equinor beat expectations in the second quarter, with the Iran war driving gas prices higher in Europe. It was a boost to the company's trading business, but the chief financial officer warned us about the state of the gas market in the region ahead of winter.
When it comes to the European gas market, it is a vulnerable situation. We are very uncertain about, how we will enter the winter as such. And a couple of data points, global LNG markets, 20% of that is sort of inside of the Hormuz Strait, clearly limiting international flows. And in Europe, 30% of the gas has to come from LNG. So there will be an increased competition for that. And if you combine that with sort of the current storage levels in Europe, which is at 53%, which is 15% below, a normal year, it is sort of tells a story about a very vulnerable situation. So we just need to be very much prepared for that. Even if sort of the Hormuz Straits open and we get back to normal, we don't think that Europe will get to the targeted storage levels before the winter. And that storage level is a very, very important data point.
Well, that was the Equinor CFO. Now, Santander has also topped expectations. The company's chief financial officer speaking to Bloomberg a little bit earlier.
And clearly, we are on track or even, on track to meet or even do better in some of the KPIs we gave for the first year of this 3-year plan. So we are starting on very, very strong footing, and we are very confident that we can deliver on the numbers we gave for the next 3 years.
You and the team have made it clear, Jose, good morning, that the UK and the US are key markets for Santander. You've made the acquisition, of course, of Webster in the US, TSB, as you mentioned, here in the UK. Are you still at the point where you're integrating those businesses, or are you looking for further acquisitions? Where are you in that story?
No, we just incorporated TSB in the second quarter. We are going to, we expect to incorporate Webster in the second half of this year. And we need to integrate these two companies, these two banks, into the group for the next couple of years. So obviously we need to, we are going to focus all our resources on integrating these two companies in the next couple of years. So no significant M&A on the table at the moment, no.
OK, does that allow you to think about maybe returning more cash to shareholders above and beyond the announced amounts?
At Investor Day, when we outlined our next 3-year plan, we made a few changes to our distribution policy. We increased the cash from 2027 onwards, from 25% of profits to 35% of profits. And we also said that if capital stays above, or when capital goes above 13%, which is the upper end of our operating range, which is 12 to 13%, so the excess capital above 13% will be distributed to shareholders.
Now let's get more from our Bloomberg Managing Editor for EMEA Finance, Tom Metcalf. Tom, so what stands out, first of all, in these Santander results?
Well, I think, pretty decent set of results. For me, probably the most specific thing would be, they did sort of really beat those estimates on net interest income. And I think that has a good read across to other Spanish lenders at least, right? Like if they're doing well there, you'd expect in their, one of their home markets, BBVA would also do pretty well, for instance. So, yeah, for me, that was the biggest takeaway. Obviously, shares not really responding, but that's all in the context of Santander shares being up something like 60+% over the last 12 months.
What did they say? I mean, it's difficult to have, concrete forward guidance given everything that's happening with the oil and the Middle East.
Yeah, but it's pretty confident. It was basically saying we expect to meet or even potentially exceed any kind of those targets we set out for the next year. So that all looks pretty positive. And again, that's kind of probably the big takeaway is, no nasty surprises in the set of results. Obviously, they've got to integrate Webster. TSB is now sort of, officially part of the group as well. But yeah, the big thing is, can they continue to execute on those two sort of idiosyncratic absorptions, but also just generally on the strategy? But it seems to be pointing in the right direction.
Tom, thank you so much, as ever, for joining us on the bank's Tom Metcalf. They're, of course, in charge of finance in EMEA. Now, coming up, shipping disruptions in the Middle East intensify as the U.S.-Iran war grinds on. Of course, we'll discuss the outlook for commodities with Michael Haigh from SocGen Corporate and Investment Banking. I'm looking at the price of oil in general, actually. If you look at some of the things that the markets are worrying about, they're definitely focused more on earnings ahead of Alphabet. Traders waiting for the clearest read yet on whether some of these vast sums of money that they've really spent on technology hyperscalers will pay off. So that's the one question, but there's also quite a lot of questions on the Middle East. This is Bloomberg. Investors turn cautious ahead of big tech earnings from Alphabet and Tesla, with concerns over massive AI spending and the chip sell-off last week. President Trump could threaten the future supply of low-cost medicines in the U.S. as he plans a 100% import duty on generic drugs to try and encourage manufacturers to move to the country. And the White House plays down the prospect of immediate peace talks with Iran as Houthi militants in Yemen continue to threaten shipping in the Red Sea. Now let's get more on the Iran war, where mediators are continuing efforts to restart negotiations, but Tehran has rejected U.S. claims that the Middle East countries are seeking more talks.
Iran has been reaching out to the United States, both directly and indirectly, to engage in talks about settling the differences with regards to what's happening in that part of the world. Unfortunately, so far, even though we have reached agreements, they have not kept their commitments. And as the president stated earlier today, I guess, today Washington time, yesterday our time here now, the problem we're having right now is that they're not serious about talks.
Well, let's get more from Bloomberg's Paul Wallace, managing editor for the Middle East and Africa. Paul, attention, of course, now on both the Hormuz and the Red Sea. So is there any prospect of de-escalation?
Hi, Francine. It doesn't look like it right now. We've just heard Marco Rubio essentially saying, well, the U.S. isn't ready for talks with Iran because it doesn't believe Iran is serious. For what it's worth, the Iranians are saying that, talks are a possibility at some stage, but they're certainly sort of dismissing any idea that they're desperate for a new round of negotiations. They continue to counterstrike against U.S. attacks by hitting Kuwait and Bahrain and Jordan. Those three countries in particular are being bombed on a daily basis with missiles and drones, and they continue to hit ships in the Strait of Hormuz. So at the moment, neither side looks like it's ready to back down, and of course, as you mentioned, we have the possibility of a new front in this war opening in the southern Red Sea with the Iran-backed Houthis warning ships not to go to dock at Saudi Arabian ports. They announced this about 2-3 days ago. They haven't actually attacked any ships yet, but if they do, that would be a major development and would likely push up oil and energy prices even further. And some shippers are very wary of these threats, and we're already seeing quite a few oil tankers turn away from the southern Red Sea to avoid going close to Houthi-controlled territory in Yemen.
And Paul, the Wall Street Journal is also reporting that the Trump administration has basically approved a landmark nuclear deal with Saudi Arabia. What do we know about it?
So we're still waiting for the U.S. to confirm this. It's possible that they make some announcement today, but if the U.S. does agree, does let Saudi Arabia enrich uranium on Saudi soil, and also say that U.S. companies will help Saudi Arabia build up a nuclear power industry, that would be very significant. And this is something that Crown Prince Mohammed bin Salman has wanted for years. It was under discussion with the Biden administration. The U.S. has long been wary of the idea of Saudi Arabia enriching uranium. Israel too. Israel has in fact already come out, or some politicians have come out and spoken against the idea in reaction to the Wall Street Journal story. They sort of feel it could open the floodgates and lead to other countries in the Middle East insisting on being able to enrich uranium too. And of course, this is all going on at a time when the US is trying to curb Iran's nuclear program. So it could send, in the eyes of some critics in the US, it could send a wrong signal to Iran, at the same time that the U.S. is saying Iran must not enrich uranium. If it turns around to the Saudis and says, well, they can, that might not be the best message in the eyes of critics. So it's something that won't happen overnight, and there will certainly be a lot of pushback from a wide variety of politicians in the U.S., but it would be significant if Trump essentially says he thinks it can go ahead.
Paul, thank you so much as ever. Paul Wallace, Bloomberg's managing editor for the Middle East and Africa. Now, we're now joined by Michael Haigh, Commodities Research Head at SocGen Corporate and Investment Banking. Thank you, Michael, for joining us. I mean, the concern is that when you look at oil, a lot of the predictions that we've done before haven't really played out.
Right.
But now there's 2 or 3 scenarios that could really get us in trouble for winter.
Exactly. No, so you're exactly right. I think most people who are trying to forecast the price of oil were relying on the traditional kind of inventory price relationship, which kind of broke because we're in an unprecedented time. So our forecasts were looking at ridiculously high prices when we started to see this conflict, given what could happen with inventories. We don't really rely on that so much anymore. We look at sort of what the options market is pointing at. So to give you an example, over the last week, and especially since the Houthis have got involved, and you look at the build-up in put options versus call options, there's about 4 times as much open interest build-up in puts rather than calls, which would lead you to believe, oh, the market's quite bearish. But it actually isn't that, because the put option build-up is really about strikes around the $70 to $80 level over the next month, whereas the call option build-up is much more spread out over the course of the year, around 120, 130. So I kind of rely on that a little bit more these days rather than inventory models, because it seems to be a little bit more sort of grounded.
But were we also underestimating at the start of this Middle Eastern war how China has diversified, or some of the other energy places of China? And does that change just the energy, how you look at the energy complex?
No, for sure. I mean, nobody would have expected Chinese imports to drop 5 million barrels a day, right? I mean, that's just a massive... That's like playing like OPEC would play. But part of that has got to do with their policies restricting product exports, so the incentive for refineries to bring in crude oil at a very elevated price, but not being able to export to the product markets where the cracks are really high, has meant that refinery run rates have dropped in China, call it 2 million barrels a day. You have no more strategic petroleum reserve build-up in China. You have demand destruction. I mean, EV sales are up 4% in China, as they are around the rest of the world. So it has done an amazing job of depleting its imports, which has helped cap where prices have gone over the last couple of months.
So what happens now?
So, I mean, basically, we've had to readjust our probabilities on these scenarios. So the probability of a stalemate between Iran and the US is probably just as equal as a narrow deal. And then there's two other scenarios, which is more elevated fighting, which I would put around 20%. So the first two are around 35 each. Elevated fighting, more than what we see right now, around 20%. And unfortunately, a full resolution is really tiny at this point.
I mean, so what happens to the price of oil? Again, I don't know, we were talking at the beginning of the summer about jet fuel, running out of jet fuel. I mean, now we're talking more about the winter months just not having it, or taking more time to replenish. But,
exactly.
But what's the worst case scenario?
Well, the product cracks are already, I mean, gasoline, heating oil, they're already like $30, $50 above the price of crude, and that can only get higher because the inventory levels are really, really low. So as each passing day goes by, and bearing in mind, between 3 and 4 tankers are now going through the Strait of Hormuz compared to 25 a month ago. So as each month goes by, it becomes more and more vulnerable. And I said that 3 months ago, obviously, and things didn't pan out the way they were. But it's for me, the asymmetry is very, very much to the upside now.
What happens in the U.S.? Because, again, and we go back to this idea that there are the midterms, that President Trump at some point will get scared and really back down because of the price of fuel. But then the U.S. is quite insular also to what's happening in the Middle East, or certainly less than, they're less dependent on it than Europe is. Yeah,
I mean, they're less dependent on the volume because they're self-sufficient. They're a net exporter, as we know. Trump hasn't imposed any kind of export restrictions that we were worried about. But gasoline's above $4 a barrel again on average. So that's a bit problematic, and we're about 2 months away from the midterms. So, I mean, we were saying that we would see a resolution by the midterms, but it's not too far away now. But the US consumer isn't really feeling it as much as you would think they were, even though gasoline's at $4. To give you an example, back in 2008, oil was $147 a barrel. When you take into account inflation and wage increases, if you're lucky enough to have had a wage increase, and the intensity of use of oil has decreased, even in the US, people aren't driving as bigger cars anymore, they're more efficient. Oil would have to go to around $250 a barrel to feel like 147 did back in 2008. I'm not saying people don't hurt by this, but it's not as significant as you think.
Talk to me a lot about some of the other commodities. I mean, what is gold? Because gold has, for me, changed in the last 8 months, right? We thought it was a reaction function of kind of a bit of anti-American sentiment, hedge events, inflation, that it's always been. And now it just feels to be behaving differently. Yeah,
it certainly does. I think that's part of the inflation backdrop, obviously, because it doesn't yield anything, as we know. I would stay away from gold for the short term. We are long-term, medium-term bullish on gold, but I wouldn't advise doing anything yet. I mean, even though using sort of high-frequency vault data movements and export activity of gold out of the UK, it looks like central banks in the last recorded month have started picking up buying again. Maybe bottom fishing on the lower oil prices, but gold prices, sorry. But I would stay away for now. I think once this resolution in the Middle East sort of takes hold, if we get that, inflation becomes less of a concern, I'd get back into gold.
Is there anything else that you would stay away from and then wait for some kind of resolution, or at least, I mean, is it resolution or progress, or is it too dangerous to to get back in for progress, because it could go back.
Well, the progress would mean ebb and flow
like a real
of traffic. You know, one week you'd have 4 tankers going through, the next you'd have 10. That would be progress. Resolution would be back to the average of 23 tankers traversing from west to east, like going out the strait. So that looks less and less likely. Yeah. Now, in terms of staying away from things, there's a few things that I would actually not want to stay away from, yeah. which is European gas. I think it's very vulnerable. I think copper looks really great, yeah. especially with military expenditures expecting to increase. So there's more I would go into rather than stay away from.
I mean, copper, and we've seen it really play out also as we're trying to build out the AI
yeah.
and the infrastructure.
Yeah.
I mean, what's the limit for copper? Price limit? Is there a price limit?
Well, there is a precedent. I mean, the way I would look at it is go, okay, when was the high in 2008 when we had the commodity super cycle? Copper was at 9,000, the marginal cost was at 4.5, so it was double. So the marginal cost of copper right now for the 90th percentile producer is more like 10,000, and we're at 13,000. Now, I'm not saying it would double to 20,000, but there's a lot of forces that are in favor of copper. There's military expenditure, there's stockpiling, there's AI, as you talked about, there's obviously the green stuff. That used to be the big narrative. The only thing I would say about copper is we still don't have a resolution yet on the tariff uncertainty in the US, and stocks of copper in the US are at 600,000 tons, which is massive compared to the 90,000 you had before Liberation Day. So if there was some sort of clarity on that, and that copper found its way into the market, copper would sell off. But I would see that as a buying opportunity. Yeah,
and gas prices in Europe, I mean, that's partly LNG coming, of course, from Qatar and other Middle Eastern, but it's also a Ukraine story with Russia.
It's the fact, and because of those features, that means that European inventory levels are at historic lows, 5-year lows, so looks very vulnerable. 60 euros a megawatt hour looks really cheap right now, given the risks that we have going into the winter, October, really, the heating season, I should say.
Thank you so much for great analysis, Michael Haigh, Commodities Research Head and SocGen Corporate and Investment Banking. Now, Ukrainian President Volodymyr Zelenskyy has dismissed the Commander-in-Chief of the Armed Forces after nationwide protests. Let's get more with our Chief Europe correspondent, Oliver Crook. Good morning, Ollie. So what's the wider significance of actually this change of personnel? Does it show Zelensky's weakness that he's bowing to pressure from protesters?
So listen, this isn't the first time that Zelenskyy has had to bow and do things that he effectively did not want to do because of public pressure within Ukraine. You had a similar scenario last year where he wanted to take more control of the prosecutors' offices and basically gain effectively more control over the anti-corruption probes that were happening in Ukraine. This is something that is an independent of the presidential office. There were massive protests in the streets of Ukraine, and as a consequence, Zelenskyy had to capitulate. You have a similar situation now unfolding in Ukraine at the very top of the military complex within the government, where you had basically a feud between the former defense minister who resigned as a consequence of pressure from Zelenskyy, and a feud he had with the top military official, the commander, General Syrskyi. So these two men are very different in terms of their approach to warfare. The younger of the two, the former defense minister, was sort of seen as pioneering the drone warfare that's really been the lifeline for the Ukrainian military, but of course the Ukrainian nation. And then the commander of the armed forces, who is seen as sort of more old style, using much more Russian style tactics, really throwing a lot of people at the front line and sort of willing to endure a lot more casualties. As a consequence, you had these massive protests. Zelenskyy has now capitulated with the resignation of the top general of the military. Now, that takes us a few things. For one thing, it tells us that Zelenskyy is obviously under pressure from the population, that he is also still reactive to this population and has to basically acquiesce to some of their demands, despite the fact that there has been a freezing of many of the democratic institutions in Ukraine, obviously because they're at war. But of course, this is still a population that is very engaged, not just in the war, how the war is being waged, and again, who is going to be waging it. So this is a really big shakeup. It's the biggest shakeup to the military within Ukraine in the last 2 years. So again, we've also got more promises from Zelenskyy saying he's going to look at the configuration of the military. So we'll probably hear more about that in the coming weeks.
Ollie, the Kremlin, we also report, has hardened its demand on occupied land in Ukraine because Putin just no longer has faith in what he thought was agreed with Trump in Alaska. So where does that leave hopes for a way out of the war?
Well, I think that Putin, rather than this being on Putin's initiative, I think it's more of a reaction from what he's seeing from the White House and President Donald Trump, and a view that basically Trump sees things differently than he did when he met with Putin in Alaska last year, and that the scenario has changed pretty radically on the ground. I mean, that Alaska meeting came pretty freshly after that meeting with Zelenskyy, in which Trump kept telling him he didn't have any cards, and the dynamic has really fundamentally changed, both on the battlefield, also in terms of the financing position, but also, of course, in terms of the military operations that the Ukrainians are able to commit within Russia. So now it seems that Putin effectively sees the deal that was sort of struck between Trump and Putin. This was never really fully a deal, of course, because no one had actually agreed to anything, but a broad outline in which there would be sort of land swaps. Putin basically saying potentially not really open to that land swap anymore, but it leaves Putin in the same position. He still has not taken the Donbass. He still needs to take all of Donetsk and Luhansk. He's been unable to do so, so it leaves him in the position of trying to figure out how to do that. There are apparently people close to him who thinks he can do it within the next year. There's a lot of skepticism about that. But for the Russians and for Vladimir Putin, coming under quite a bit more pressure, not just on the military front, the strikes within Russia, and of course the economy buckling.
Ollie, thanks so much. Terrific briefing from Oliver Crook there in Brussels. Now, coming up, it's the second full day at work for the new UK Chancellor. We'll find out what the City of London is expecting from the Treasury. That's coming up next, and this is Bloomberg. Welcome back, everyone. Some encouraging news for the new British Prime Minister Andy Burnham, as UK inflation fell to its lowest level in over a year on cheaper motor fuel and cheaper food. Now, the respite for consumers may be brief, with higher energy bills set to complicate the short-term outlook. Now, let's get more with Rosa Prince, Bloomberg opinion columnist. Rosa, thank you so much for joining us. We kind of spent the week together trying to figure out exactly what we can read the tea leaves of this new cabinet. What kind of Prime Minister, or what kind of cabinet is the Prime Minister trying to convey the image of?
Well, today he set out his second measure to alleviate the cost of living, and he actually said that his cabinet would be a cost of living cabinet. So today it's a measure to cap bus fares. How he's paying for all this is interesting. A little bit of jiggery-pokery. He's taken some money away from some climate financing overseas, rather. But I think he's also dropped some hints about his sort of bigger picture. He had hoped, I think, to raise the tax threshold. He had said that was something that came up for him on the doorstep when he was out campaigning to get back to Parliament. And he also kind of left open the possibility that he would raise the higher level to 50 pence. Both of those things have been quashed overnight. They are now briefing that all savings will have to come from within departmental budgets. So I think they're still kind of figuring this one out. I think he wants to be someone who splashes the cash around, but he is aware that he needs not to frighten the markets and to stay within those tight fiscal rules that were signed up to at the last general election.
Rosa, really quickly, I mean, there seems to be also the willingness from the UK Prime Minister to provide strategic support to the US on Iran. That seems like a shift.
Yeah, that was a big question, whether he would be a little less in America's pocket than Keir Starmer was, certainly for most of his time in government. But we have heard that he is willing to approve the use of those bases to support Iran. Yeah. I think he felt with a slightly controversial new foreign secretary, he didn't want to rock the boat. Last thing he needs is Donald Trump's ire at this moment when he's just setting out.
Rosa, thank you so much. Bloomberg opinion columnist Rosa Prince. Now, to discuss what the city wants to see from the new government and the Chancellor, John Healey, we're joined by Chris Hayward, Policy Chairman at the City of London Corporation. A joy to have you as we try and figure out exactly what this new government wants. So what are the City of London's thoughts, first of all, on the new Chancellor? I mean, he's a known quantity and he seems to be well regarded. Do they worry about taxes?
We always worry about taxes, I think. Look, we want the Prime Minister and the new Chancellor to be pro-business. Prime Minister has said he is, and actually, when you look at his track record of what he did in Manchester, he worked with business to actually create that prosperity in Manchester. So for us in the City of London, what we don't need is more taxation. What we need is economic growth. And so my offer to the government is to partner with the government on initiatives which will actually move the dial on economic growth. The reality is, in the past 2 years, there has been no economic growth. It hasn't moved the dial one iota. And actually, if we can start to get businesses being more successful, I mean, the sector I speak for, financial services, 2.5 million people in that. We contribute 12% of the government's tax take, and those are actually all over the country. 2/3 of them are outside of London.
But is there a danger that this takes time, that the government doesn't have time because they just need spending money?
Well, the government has to invest the time to make the right decisions. It's not for me to prioritise what the government spend their money on, but I do think and I understand this need to get cost of living down. But what the Prime Minister and the Chancellor, I think, need to focus on is how do we get greater tax receipts? Well, we get greater tax receipts not by greater taxation, but by greater success. Taxes will go up. People will pay more if their businesses are making more money. And what we want are pro-business initiatives in the City of London, which really drive that economic growth. Because if we can get 1 or 2% on economic growth in the next 2 or 3 years, that really will transform our economy.
Is continuity feasible? Because chief executives don't like chop and change. And what I'm hearing this week is actually we just have to wait for the budget come the autumn.
Well, look, I think the fiscal event in the autumn is always important. And business does want stability, right? We want constancy. Business likes to know the direction we're going in and that we're staying with it. And that fiscal budget will be very important in terms of where the Chancellor and the Prime Minister see their priorities and how they want to finance them. But I do think at the moment what we've got to see is more money coming in to the Treasury, and that will come if we get business driving the agenda. And that's what the city's all about. We've got deep pools of capital, and what we want to do is invest them across every postcode, as the Prime Minister would say in the country. We've got an Invest Connect policy, which is about how do we get the nations and regions actually invested in, and we're really working hard to partner with government on that.
And that's very clear, and it's kind of like, again, this idea that you want growth and that the City of London will support it. Is there anything that you're worried about that actually the City of London is really fretting? Is it stamp on, shares, stamp duty on shares? Is it bank taxes? We heard Jamie Dimon talk about this earlier this week.
Look, I don't think we want any more taxes on banks. Our banks are already taxed higher than any other competitor banks in Europe. So that I don't think is the way forward. I think from the city's point of view, what we really want to see is, the Chancellor and the Prime Minister recognising the source of wealth and the source of capital that the city can be, and our ability to distribute that for inclusive growth across the United Kingdom. So that's my message to government. It's, work with us, don't work against us. If our businesses succeed in the city, it will transform that capital out into the regions. And that's where, under devolution, that's where the Prime Minister and the Chancellor want to focus their efforts.
I mean, a lot of the, City of London workers are also movable, right? You can kind of work from anywhere in the world. If Andy Burnham were to introduce a 50% top tax, do you think workers and employees will ask their bosses to move them elsewhere?
Well, look, one thing I don't want to see is a brain drain to any other country. There is a global battle for skills. We need the very best people here in the City of London. So anything that drives them to think about wanting to work elsewhere is not good. So I would say, don't put up the taxes. What we need are incentives. How do we incentivise innovation, enterprise? These are the ways forward, actually. If we focus on those rather than actually increasing taxes, then I think that's the right way forward.
Would it be unfair to say that the last government also tried? Was it because they were distracted, or it wasn't the right framework?
They were very distracted. I think we have to be clear that over the past 2 years we've had some of the most geopolitical explosions in the world, and that's really impacted on this on this government. Not just this government, but other Western governments. But if they can get inflation down and they can get capital up and capital investment up, I think they stand a real strong chance of actually turning the dial.
Yeah, great points. Chris Hayward, thank you so much for joining us. That was the policy chairman at the City of London Corporation. We'll see exactly what happens, and then we'll also see what the business secretary and the city minister have to say. Now, this is the picture across the board for a lot of these equity markets. Look, stocks are falling behind as they're waiting for Alphabet's earnings. Traders waiting for the clearest read yet on whether the vast sums that technology hyperscalers are pouring into AI will actually pay off. I'm also looking at high crude prices, so you can see Brent a little touch higher, and they're keeping a lid on sentiment after both the U.S. but also Iran signaled they are in no mood for the moment to restart talks. Up next, it's Bloomberg Brief, and this is Bloomberg.